piled on, this cycle will not go away, and it's going to take a long time. Now, you can get overly pessimistic and say that the United States is just, the debt situation is never going to go away. But we tend to forget that if we stop fighting wars, a lot of money comes back home, and a lot of things can be salvaged. We saw that during the Clinton era, when we no longer had Vietnam Wars, the Cold War was finished, nobody was doing the silly stuff and building armaments, and the U.S. economy did quite well under a Democratic president, which is unusual, but Clinton was probably a very small D Democrat. So, if the United States can solve some of the issues, the trillions of dollars they're spending on defending the world and really come back and find peace, then the situation can change very quickly. The one thing I've known is cycles, there's always cycles, and there's always change, and there's always opportunity. In fact, chaos is probably the best thing for an investment manager. The greater the amount of chaos, the happier I am. Give me war, give me hurricanes, give me pestilence, give me whatever. There's always an opportunity to make money. I know that sounds really, really bad, but...
Hey, it's real.
Yeah.
It's real.
Because it creates uncertainty. And right now we've got uncertainty, and everybody's chasing, everybody's afraid. Like, the people are still not buying the stock market, which is good. I hope nobody buys the stock market, because that means that we're okay. Everybody's still buying income. Everybody's focused on trying to get income in their portfolios. And that's probably the most crowded trade there is. There's probably a series of crowded trades. Shorting the US dollar is a crowded trade now. Gold is becoming a crowded trade. It is because it's, gold keeps going up, and fear. Gold is a barometer of fear. So if the economy starts to get better, which we think it's going to, then you run the risk that the US dollar starts to rise, interest rates rise because the economy is better. Commodities will go off, but then we do think that perhaps there's a good cycle in the tech side on a go-forward basis.
Is the Canadian stock market representative of the Canadian economy?
No stock market in the world is representative of the economies anymore. Certainly the Canadian stock market has no bearing, because most of, I'd say 50, 60% of the companies, well, probably even higher, I'd say 80% of the companies don't do any business in Canada. And if you look at the United States too, if you look at the largest companies in the United States, 60% of their revenue is outside of North America now. Your IBMs, your Microsofts, your Googles, those companies are international companies. So are they a true reflection of the U.S. economy? No. And, the issues in the U.S. right now are obviously housing and the overbuilding of housing and very low interest rates. And if you look at the balance sheets of the major U.S. companies, they have tons of cash sitting on the balance sheet. Billions. Cisco, $9 billion, Intel, $4 billion, Microsoft, $18 billion. They have massive amounts of cash sitting on the balance sheet, and they continue to generate. So even in the depths of despair in 2008, when bankers were ready to jump off buildings, a lot of corporations were in very, very good shape. But because the banking system collapsed for a period of 2 weeks, and it's a good thing most people didn't know this, that no banker would lend to each other, never mind to a corporation or to you and I. They didn't even trust each other for a while there. They just shut down. There was no interbank lending, not for a minute, not for a second, not for an hour. And it was a very, very scary time. But corporations themselves were in pretty good shape. So, even in the 30s, a lot of you could make money in the depths of the Depression, because there were a lot of really good corporations that survived through the peace and became very dominant companies. And that's what we have right now, is we're seeing the dominant companies come forward.
What effect do you think Barack Obama's plan to tax or fine or feed the banks is going to have?
Well, I think we have to recognize the fact that there's going to be more regulation. And with regulation, there's probably more taxes. It's interesting that Bernanke basically said it wasn't the Fed's fault. It was regulation that failed. And that's partially true, is when the banks started to look like investment bankers rather than banks, that created this greed factor that inherently drove the problems that we had, and the leverage. And to this day, there is a need for more regulation, where you can lever gold. I can go out and buy an ETF for $10, and that gives me the same action as gold. So what does that tell you? Gold's trading at $1,200, yet I'm buying an instrument for $10 that gives me the same characteristics of it. That's leverage. And then there was so much leverage in the system, and there still is a lot of leverage in the system, that you don't know what's real. And that's the problem, is that over-the-counter markets have blossomed for derivatives. Pension funds are now actually buying hard assets such as oil, such as gold. It's become an asset class within it. So it creates another layer of speculation. The one thing for sure is that there is going to be a lot of volatility going forward. They're all, and it's going to be more, and cycles are getting less and less. There's no longer a 10-year cycle. There's no longer a 7-year cycle. It could be a 2-year cycle or a 3-year cycle. And you have to be nimble, and you have to prepare for those things. So it's an interesting time. It's a scary time, but you can make a lot of money as well in these interesting and scary times.
So we're sitting here together, and I've got this unique opportunity of asking you just, how should I position my portfolio today? How should an investor position their portfolio? Will bonds outperform equities?
I think equities will outperform fixed income instruments, certainly outperforming cash at this point. I do think the economies are improving. I don't think interest rates are going up in the foreseeable future. The recovery is going to be very muted, so therefore you're not going to see a lot of pressure on rates. And at the end of the day, the longer you look at your savings account making no money, the more likely you're going to take some risk. And that risk, once you make that decision, you're going to have to buy something, and by buying it, and if everybody makes that same decision, things are going to percolate up. I think the market last year recovered very nicely. I think there is some risk that we can get a correction of some magnitude, but governments are on a course to make sure that we get through this. And as long as their resolve is still in place to keep rates where they are, I think we'll recover very nicely. And I think you have to really focus on those areas where there is a lot of activity, where there's a lot of capital spending. Governments are willing to build bridges, so engineering companies